Hey everyone, Anthony Gerbi back with another edition of Thursday Thoughts. We are continuing our series, The ABCs of Finance. And this week we are on the letter Q is for quantity, which is, again, a very vague term. This is a book for children, of course. But one of the things that I think is worth talking about when related to quantity is, and I don't necessarily get this question, but I think this is what's at the root of a lot of other questions I get. How many different investments should I have? Not just accounts, but I mean, how many different investments within one account should I have? How much do I need to be diversified? I've heard that this diversification thing is really worth pursuing, and I agree that it is. The answer is slipperier than we would like, right? I don't think for the average person, it's right for you to own just one stock or one company, for example, because then, of course, your fortune is very much tied to the rise and fall of that company. However, the principle of diversification just says we need to have many different companies, if you're thinking of the stock market, but also types of investments like stocks, bonds, fixed investments, things that do different things at different time periods. That's important because we want to be able to weather a period where the stock market goes down and maybe bonds stay higher, for example, or we want to be able to benefit when the stock market goes higher and bonds don't perform as well. And it's hard to just switch back and forth between one thing to the other, right? If we could do that, we would, but nobody do I have the confidence in to be able to do that. So the quantity of investments is tied to your risk. If you are somebody who says, I'm very meat and potatoes, I don't need anything fancy, I just want something that's diversified and that'll grow, that could be one fund that owns many stocks and bonds. It's diversified within one fund. There's nothing wrong with that. But I think for the average person, you're going to want to go a little bit more because there are benefits to owning specialized funds, investments that do things that other ones don't. They invest in a particular part of the market. They invest in a particular geographic area. All that different stuff can be kind of zeroed in on. So there is no perfect answer for this, but the answer is almost certainly, in the case of stocks anyway, more than one.